Hey everyone, welcome back to my channel. This is part 4 of my volume price analysis series. We've already covered how volume plays into this technique using both volume at time and the volume profile. But now we need to cover what is probably the most important aspect, which is price action. I'll also be discussing how you can identify liquidity pools, market news events that can also drive price, and how positive and negative gamma can help determine if you should be bullish or expect volatility. Now, before we get started, if you'd like to get a 10% discount for TradingView, don't forget to use my referral link in the description. You'll also find referral links for TradingView and Top Step funded trader programs that will give us both discounts. It's just nice to have that, especially if you use that software. Lastly, if you enjoyed this content, don't forget to like and subscribe to help me grow this channel. This is something that I love doing, and I will definitely have plenty more coming out in the near future. And so if you haven't already watched volume price analysis parts 1, 2, and 3, make sure you check those out to fill in some blanks. I should have 1 or 2 more parts coming out after this video. So that being said, let's go ahead and get started. So price action, of course, is reading the candles in front of you, reading the chart to determine what is happening. And it really is the number one aspect. I mean, the chart can just tell you so much, the candlesticks can tell you so much, and this isn't like a beginner entry level, how to read the open, the low, the high, and the close of the candle, but we will talk about how price action is going to point out exactly what's happening in the market. So the first thing I want to touch on are fundamental news events that can influence price action, and we actually saw an example of this on Wednesday, June 1st. So you can see at 10 a.m. we had job openings and quits. And I knew ahead of time, I've done other videos on this, how every single day when you're prepping for your week over the weekend, and when you're prepping for your day in the morning, you should always be checking for market events. I use Market Watch. I believe TradingView also has some news stuff that you can look at there. And so right away going into this day, I knew that this would become a thing, this job openings and quits, if it was, and we wanted to see how the market was going to interpret that. So I can go ahead and pull up the chart here. And on this day, so this is SPY, you can see going into the market, we actually opened up and we bounced off of a high here and then started moving down. Now right away, this price action, these candles already can tell you that this level's holding. So when you see something like this, when you see it move higher and reject, move higher again, and actually for the sake of this video, I am going to turn off volume and volume profile because the only thing we are concerned about is price action and levels. So when you see this here, this rejection start happening right away, short should be on your mind. Now, not everyone likes playing the opening range, and that was even more so a safe bet this day because of the news coming out at 10 a.m. Eastern. And you can see, who knows how this day would have gone depending on if we didn't have that news. But you can see, so we bounce off a pre-market level, come back up. This would have been a good exit for your initial entry. If you bought puts up here, then you'd want to close those here. And then the news hits, and we start seeing it pushing down. And this is where you really want to start paying attention to what the candles are telling you, because even though we come back up, and I'm looking at the 5 minute, I also enjoy the 3 minute. I would not recommend the 1 minute. It's just too hectic. I'm doing the 5 minute here because it's nice and clean. And many good traders do actually trade on the 5 minute as well. But you can see when we moved up here, we start moving back down. We push down after the news. And then this time, when this candle starts coming back up, immediately we get this huge move, this strong candle going through it. Now we don't have volume to tell us just how strong it is, so we are missing a piece of the puzzle. But even without it, and as a challenge, you may even want to try to practice trading with just price action to get good at reading it. But I mean, as soon as we had the news right here, this tells us, okay, the market did not like this news, and this was a great time to take put entries. And I mean, you could easily hold it all the way. I mean, you kind of start seeing it trying to push up at this level, and it just gets sold right into, easily held into here. And I wouldn't have taken calls here because it's just such a bearish trend. I would consider buying puts again, when you start seeing the wicks here, the candle formations here, which we already know is a level. And honestly, this level might even be slightly off. These levels were already pre-plotted for me based on other videos. I discussed how to plot those levels. But as soon as we start seeing this bear hammer form and moving back down, or even these bearish candles here where we try to push up and move down, push up and get just shot down again, then you could definitely get into puts again. And this candle most likely would have gotten me out, being honest. And then when we start to see a bottom, we get a double bottom, and this tells us, okay, the move was made from the fundamental news events. So at that point, you can start playing it as normal. But we learned a lot. We learned that during this fundamental news event, something happened here. That, this is a huge sell-off, and something happened here to disrupt that. Nothing else was able to disrupt that. And then we get into this zone, we get into this area, we touch down here, and it gets disrupted. And that's something that you should be thinking in your head, okay, why is that? And you want to, if you didn't already have that level marked, you need to mark it. And that's where we start getting into liquidity pools and volume. Now, again, we're not talking about volume here. I've deliberately turned it off, but you can see this liquidity pool, this volume that stopped us here. Let me go back to the chart. This volume that stopped us here came into play later in the day. So even as we got down here, and you start to see this double bottom, meaning there's even more liquidity down here. There's even more buyers down here. And when I say buyers, I'm talking about big money, hedge funds, banks, market makers, as they're called, smart money, whatever you want to refer to them as. That's who I'm referring to. And it's not like they have a guy that's just sitting around who's like, oh, at this price level, I'm going to buy. But what they do have, and there's a lot of factors that go into it. It goes into how they hedge for the options they're selling. It goes into dark pool exchanges. It goes into previous levels, previous price levels that they've bought the options at. All that plays a factor into where they're going to buy. And so what this tells me is that when we hit here and this huge downtrend that was caused by a big market event gets stopped cold and even pushes up for a dollar or so, or almost $2, that tells me that some algorithm here is kicking in and buying this up. And we get pushed down, and eventually does make it through, but it's just such a strong level, it needs to be marked, and it's going to come into play later. Now, the first thought to me would be, okay, is this line going to act as resistance when we come back up to it? And sure enough, it did. But then when we actually see a strong break back through it, then we're looking at it as support again, because we know that this algo, whoever it belongs to, whatever smart money it's tied to, that this algo wants to buy at this level. And so when we break it, and again, I never chase a breakout, but when we come and retest it, this is where you'd want limit orders ready to go. If you're on ES buying futures, then you want to have your longs ready to go. If you're doing options, then you want to have your calls ready to go. And it's a little trickier to limit buy with calls, especially when you got to kind of like factor in delta, gamma, and IV on the fly. And if you're doing zero DTEs, even some theta comes into play there. But anyway, you want to try to get in here, especially when you see this green candle start to form, because we know there's a buyer there, and we also know that from this double bottom, and I'm not a big pattern trader guy. I mean, I do spot them and I do pay attention to them. I'd be lying if I said I didn't. Like when I see price action not able to break through the same level over and over in those double and triple bottoms, I know that there's big buyers stepping in there, and the price action tells us that. And once again, the candle wicks, no volume, nothing else. We can just purely see on this chart that big buyers are coming in here, pushing it up, test it again, and they're giving even more, pushing it up even higher. And you can see this candle actually came lower. We made a lower low, but it got bought up even harder. It's like it triggered more liquidity, it triggered more volume to come in and start buying it up. And so something like this is also another good reason to get in. Now, if you get in down here, chances are the smart thing is, because you don't know if this will be resistance, is to get out right here, and then you take your profits, and that's fine. If it keeps going, then just be patient, and you can always take the break and retest. And if you don't get a break and retest, that's okay. You cannot be mad at yourself forever just taking profits at the next level, because that's exactly how these need to be played. They need to be played level to level, where when we start seeing a level getting defended, if we're inputs here, we're just breaking through hard here. There's just no stopping it. I mean, even if you did take profits here, you should be getting back in here when you see a candle like this straight through a level. But as we go down, and we get to this point, this is a cue to take profits. And then even if you don't re-enter on these candles anticipating a breakthrough, which is perfectly fine, when this double bottom happens, that's definitely a cue to get in. And then you have the break and retest. So, and what I'm always trying to do when I'm reading price action is I'm thinking, okay, where's the liquidity at? Where are the buyers stepping in? And how strong is that level? And it really does tell you. I mean, this is a very strong level, and this was a very strong level because of the type of downside movement from a fundamental macroeconomic event happening. It was able to actually stop that up. So that's a big consideration there. So for those that don't know, I mean, these candles tell us a lot. Like I said, I don't want to get into like the open, low, close, high aspects, but I just do want to take a second to point out that candles indicate bearishness or bullshness based on what happens. So we could see here a big sell-off on a candle, and then it gets bought back up. And this applies to any time frame, not just intraday trading. I'm concerned with, I trade intraday, 3-minute, 5-minute, but I always look at the higher time frames, and I'm always paying attention to what these candles look like and what they're telling us. So this is a very bullish candle. If we saw it flipped upside down, it'd be a very bearish candle, because it means that all that price, all that sellers try but fail, and buyers push it back up. So this is a bullish candle. You can see here when we have it about 50% of the way, or as it's stated here, below 70%, it's more of a neutral candle, right? And then it's the same sort of thing as buyers become weaker with pushing it back up. This is bearish sentiment, right? This is typically, you're going to see these during continuations. And if we flip back to the chart, I mean, you could see perfectly here, we didn't even come up 30%, and sure enough, we get a continuation through the level break. Didn't even come up 30% continuation. Here, very bearish candle, because we got sold into all those buyers got bought up, right? So that's a bearish continuation. We just have hyper bearish candles from here all the way down to here until this one, and then right here, this can be considered neutral to bullish. And again, that's why I wouldn't be taking calls, because of the move it's stopping up. But sure enough, once we get to this level, we get back to our bearish candles, and that's where we can take entries again. So if you want, maybe screenshot this or something. This is just useful to reference, so you can get an idea of if we're seeing bullish, neutral, bearish, indecision. Remember, you can flip these upside down, and then the opposite is true. It's the side of the wicks is really what matters. Is the candles are every single candle is telling us a story, and that's why it's nice to watch the 5-minute and always look at higher time frames like the 30-minute and the 4-hour and the daily and the weekly, because each candle has more value the higher the time frame, so it tells more of a story. And that's why I don't like going to the 1-minute, because the candles can be very deceiving. They don't tell as much of a story. And I mean, you can see this is very bullish candle. This is saying, okay, if we can't break through this level, we're going to be going up. And that's exactly what happens. We don't ever end up breaking through it. And there are times, like, I don't always wait for candle closes. It's never just one candle. I'm always thinking about the candles, what they mean in conjunction with one another. I never just take, okay, this one single candle means everything. I need to buy, or I need to sell, whatever. No, you need to, the candles tell a story. It's you're reading the candles together, looking at what came before it, and paying attention to what comes after it to make sure that the thesis that's being formed in your head is accurate. So that is a good kind of reference point, what these candles mean and why they indicate what they indicate. Now, I already touched on this a little bit, but we want to talk about play level to level using candle confirmation. I'm not going to get into how I set levels here, and that's because I've talked about it in previous videos, so I highly recommend going back to watch those. But again, we're playing level to level. So when we see levels hold, that's when we know to take a put entry or to exit a put entry. And if we see strong breakthroughs on levels, that's when we know to get in. And what I'm always doing my best to make sure I hold into the next level. It's very rare that you see it just all of a sudden reverse. As long as your levels are good, as long as your levels are solid, and the videos I've done on using volume profile to create those levels, using gamma exposure to create those levels. Also, I'm going to do a video on looking at dark pools to create very strong levels in the near future. You need to be able to ensure you're creating strong levels that are based off several different factors. And most importantly, well, not most importantly, but another very important aspect is that it's being done on higher time frames as well. And then you're making sure it matches up with lower time frames using all the data you have available, because you need to be able to trust these levels. As long as you can trust these levels, then you can trust what the candles are telling you when we react to these levels. And we're not just fine. We don't want just any level. We're not like, I didn't mark a level here, even though some people actually would. But the fact of the matter is, the levels that we're picking need to be based off that we need to think about, okay, is this going to be a level that smart money is going to react to or have a strong reaction to? And there are times where I'll have a weak level marked, meaning like it looks like it holds and it just clumsily breaks through and it really ends up having no meaning, and I delete it off my chart. And because if I leave it on my chart, there's a chance, if it didn't already, in the future it's gonna give me a loss of some sort. So it's all about playing level to level, holding level to level, and you can even use your levels to trail your stop. So every time we get a bearish candle with a level break, so if we were in here and we broke through here, you're sliding once this candle closes, slide your stop to here. And then as we break through here, and chances, so this candle did close under, and so if you did slide your stop here, you would have been stopped out, but that's fine because you already had a significant amount of profit. And there's ample opportunity to get back here at this candle and then do the same thing and slide your stop lower. So now the next thing I want to get into, and this is about overall sentiment of the day, is gamma exposure. And I've talked about gamma exposure in other videos, and I'm going to get into it more here. Now I'm not going to talk about the level setting aspect of it, but I am going to talk about the difference between negative gamma and positive gamma and what it means on how we take plays throughout the day. So the day that we were just looking at was a high volatility day. There was a lot of negative gamma in the market, and there was a fundamental news event. Two big considerations, because it's not just options in gamma that drives markets. There's fundamental news events. There are fundamentals itself, like the underlying equities and things like that. But options are a big factor in how markets move, and so we can count on that data point to help us make decisions throughout the day. Now, when we're in a negative gamma environment, it creates high volatility. When we're in a positive gamma environment, we have slow and steady price moves, typically in a bullish direction. The reason for that is because a negative gamma environment indicates that there's a lot of calls being sold and puts being bought, which are overall bearish, but it also changes the way that hedge funds, the smart money writing these options, hedges. And so what they do is they actually will, when it's a negative gamma exposure day, when they sell a put, so someone else, a retail trader, whoever it might be, a speculative trader is buying a put. Now the put, since they're the seller of the put, they have directional risk. If the stock or whatever they sold the put on is moving down, they're taking a loss. So to hedge that loss, they will actually sell futures, which essentially gives them short side protection, downside protection. And then in a negative gamma environment, if calls are being bought, they end up buying futures to hedge that risk. And what that means is it exaggerates each move. So on the left side here, I have a chart, which is the day we were just looking at, where we had a lot of negative gamma in the markets. And you can see when we started moving down, it was like a feedback loop. And what was happening is the markets are moving down, and they're selling futures on top of that, which is pushing it down even further, even faster. And it's not until we get into a big area where people start, a big support area where people start closing up their puts. It started happening here, and then it happens more so even here. People start closing up their puts, and in some cases, some might even start buying calls. But essentially, they can finally slow down, and they no longer have to sell futures, and they have algorithms that do all these calculations. And so that feedback loop starts coming to an end. Volatility starts plateauing. I don't want to say dropping, but it starts plateauing a little bit. And then what happens is people might start buying calls when they see an indication to do so because a price level is hit or a double bottom or whatever it might be. And so now they have upside directional risk because they're the ones that sold the calls. So if it goes up, they lose money. So to hedge that, they buy futures, right? And so people are buying calls on SPY. They're the sellers of those calls, allowing them to collect premiums. They don't want any directional risk, so they buy futures to hedge that directional risk. And once again, it creates a feedback loop and pushes things higher. And that's what creates all this volatility on negative gamma days. Outside of major news events, the volatility that we've been seeing in this bear market is because there's so much negative gamma in the markets that the way it's causing these hedge funds to hedge so they can collect their premiums by writing options and minimize the directional risk is the way they need to hedge just helps compound that volatility. So when you see negative gamma, it doesn't mean a down day, it means a volatile day. And that's an important thing. It means prone to reversals. Look for your double bottoms and your double tops. Now, let me just back it up here 1 second because I want to talk about a positive gamma day. Now, when there's a lot of positive gamma in the markets, and that typically means people are retailers, speculative traders, are selling their own puts and oftentimes buying calls. And that tends to stabilize things. And interestingly enough, this was a highly volatile day. A lot of negative gamma in the market, big news day. The following day, there was almost no news. I don't think there was any news that the market was concerned with. And it was a positive gamma day. And I'll get into in a second how you can check that. And you could see we started off very choppy. And then as things sort of leveled off and we started moving up and we get some strong moves, like we get some indecision and then we get a strong move through a level. And all of a sudden, things just are calm. And that's a positive gamma day. They shift from creating volatility by buying and selling to exaggerate the moves to supporting the markets. So they themselves will actually help. So they themselves will sell puts and buy calls. The behavior changes on these hedge funds. And what that does is when there is a downward move, it levels it out. It forms a bottom basically, and then as it starts pushing up, it's just kind of a slow and steady push, and the markets just gradually move up. And we saw a lot of that for a very long time. I mean, after post-COVID, pretty much all of 2020 after March was a positive gamma environment where it was just a slow and steady push up. And that's when people are making money hand over fist on their portfolios. Their long-term portfolios look good, and positive gamma after positive gamma. Now, unfortunately, in recent times, because of all the economic stuff going on with inflation and rate raising and the Fed and money printing, and there's so many reasons for it, but without getting into all those, we have been in a very negative gamma environment, a very highly volatile environment. It's a bear market overall. We are downtrending, but the thing to keep in mind about a bear market is that they are extremely volatile. It's never just straight down. There's big swings up and down both ways, and therefore it's something that we need to be aware of, that when there's a lot of negative gamma in the markets, that we're going to be prone to big swings both up and down. When there's more positive gamma, we can actually play this differently. And what we want to do is, in a positive gamma day, we want to make sure that we're still being smart about where we enter in. We want to enter in on level holds. And right here you see these bullish candles start to form at a level. This is a great entry point. And as we push up, the nice thing about this is normally I would get out, but on a positive gamma day, I might actually consider adding calls here as long as we don't break below this zone, the top of these candles here, then you can actually add calls, and then you can do that again at each level hold, at each confirmation that we're moving up. Just keep adding calls, and then by the end of the day, I mean, as long as they're not 0 DTEs and theta is not a factor or something like that, which I don't recommend people doing unless they know what they're doing. But you know, if you have 1 to 2 days till expiration, you can keep adding calls and then close it out before market close. And I mean, you just made a killing from 407 to 417, a 10-point move where because of that positive gamma, because you were aware of how the underlying options activity was going to drive the way that the markets were hedged, you can literally add a position and maximize collecting 10 points all the way up on SPY. And these positive gamma days are great. There was a point in time where these positive gamma days were happening every single day, back to back to back, except during FOMC minutes meetings. We'd get some volatility, some negative gamma, and then boom, we'd be right back to a positive gamma day. And that is no longer the case nowadays. We are mostly in negative gamma days. So instead of days looking like this, more often than not, days look like this. Or even worse, days look like this. I mean, this is a ugly day, right? There is some macroeconomic news. We had the president speaking, and that kind of the stuff he was saying the market didn't like, so it was driving things down. But again, I mean, look at these ways. This is just horrible price action, horrible, very difficult day to trade, and it's very difficult to trade these sorts of days just purely on price action. I was able to have a pretty profitable day today trading this, but it was really due to reading price action with the help of volume profile, which if you want to learn more about, please make sure you watch part 3 of this series. I get into it and how I use it. Down here was a value area low, up here was a value area high, and I literally took 3 main plays today, just playing from the it was more than 3, but the main plays were playing from the value area lows to the value area highs and maximizing profits that way, and trying to my best to not get shook out from all the chop. But you know, we still had some bottoms. We had 1, 2, 3, 4, 5 touches here where this was a value area, and you can see even just on the price action, this tells you there's liquidity. This zone down here is being protected, so you can know to buy calls here, and you can exit at the levels that you have. You know, this wasn't a day where you want to be holding onto positions for too long, especially if it's just raw price action you were reading with no help from volume. But what we could see here is this was a very negative gamma day, and so at this point you're probably wondering, okay, how do I know if it's going to be a negative gamma day or a positive gamma day? And this is where TradeView comes into play. So what you can do is they have their they show their gamma exposure, which I use for levels, but also you can see what's called referred to as a volatility trigger. And what that means is if we go to the options dashboard in TradeView and we go down here, a volatility trigger would be, you can see we're in a negative gamma environment. We have all this negative gamma, and there's actually two ways you can see this. I'll get into the second way in a minute. But when you see this flip here, this is what I refer to as a volatility trigger, and I've seen other services refer to it. That's where I got the term. And what this basically means is once we get over $4.15 on SPY, that we're going to start shifting to more positive gamma, and things are going to stabilize. And that's actually what happened on this day. At that point in time, the volatility trigger was 410, and once we got above 410, we just see all the stability come into play, and it was just a much calmer day where we could count on just buying more, adding calls on every pivot or adding longs on every pivots, and holding until, as long as there was no major event coming in, we were just smooth sailing. So on this day, the volatility trigger unfortunately was at 415, which we never reached. So according to the theory behind gamma exposure and how hedge funds hedge, and this theory comes from people that have worked for these major hedge funds, helping us retail traders out by putting that information out there. And if you don't believe me, you can confirm it yourself using other resources out there. But Basically, if we were to get above, you can see in the pre-market we dropped below that the levels that were considered to be the positive gamma levels, and we never got back above. If we had broken 415 and held above it, chances are things would have stabilized and it would have been a much smoother day to the upside. And so that's one way to view this. Now, the other way is looking for a gamma flip level. And now this was recently added in by TradeView, which is really nice. And what this shows us, the gamma flip, and you can see it up top, gamma exposure profile, it shows where gamma exposure value will be if the underlying stock price changes. The GEX flip is the point where gamma exposure goes above or below the zero value. This is the flip point where we go from being in a highly volatile environment to a more stable bullish environment. And so if you don't already know where you can find this at, is right above what I was just looking at. So this is the SPY gamma exposure profile. You can see this for QQQ and IWM as well, and really any stock, but this whole gamma hedging concept I'm referring to really it's more so centered around things like SPY, QQQ, IWM, and the related futures like ES, NQ, IWM, RTY, even Dow, because these are main ETFs and indices that the markets are based around. There's a whole concept of program trading that you might want to look up. And essentially, when this is how they hedge, they use these ETFs and these indices and these futures to hedge all the options that they're writing on different equities. And so that's why gamma exposure is such a big deal when it comes to these main indexes and ETFs. And you could see here the point, based on the expirations, the point at where we get into some really stable where we get into a really stable gamma environment, unfortunately, isn't really until we start to get to around 428.50. Now, as I mentioned before, once we start getting up here above 415, things will stabilize, but you can see how this negative gamma just sort of disappears as we get higher and higher and higher. Right here, 438 to be exact, 428. If we were to break and hold above 428.50 and there was no major macroeconomic event that could disrupt that, meaning we have a quad witching day. If you're not familiar with that, please go look it up. We have that coming up this month, I believe, on the 17th. We also have, which is considered a big options expiration event, OPEX event, which could disrupt this whole thing if we did get above 428 and things stabilized. It could easily be disrupted right after the 17th. So it's important to check this stuff every single day to see where we're at, see where the gamma flips might occur and the gamma exposure levels are at. But that can help you make really wise decisions when you are reading price action. So I always use these in conjunction, not just for levels, but for determining if this is the kind of day I'm trading or if this is the kind of day I'm trading. And the good news is price action will help you navigate this. The better you get at reading these candles and reading what they're telling you. Thankfully, you don't only have to use price action. I highly recommend using volume as well. Can't recommend it enough. But you want to use all the tools available to you to navigate this that are non-lagging indicators. I'm a big fan of non-lagging indicators, which truly are just price action and volume. And so once you get good at reading this stuff and you get good at establishing solid levels and you get an idea of the kind of gamma environment we're in, how hedge funds are going to be hedging and driving markets, you will be consistently profitable every single day. And this stuff really does work. And so anyway, I really hope that you learned something out of this video. Feel free to ask in the comments if you have any questions. I know I covered a lot there, and I really appreciate everyone's support and the response I've been getting. So thank you for watching.